Thanks, Aidan, and thank you all for taking time out to be here. I jumped at the occasion to come back to Ireland. I always get a very friendly response, and hopefully today you won't disappoint me. It's been more than 8 years now since the first bank in the eurozone failed and was bailed out by the German government. And there's still no end to the crisis in sight. On the contrary, catastrophic mistakes by eurozone policymakers, primarily Angela Merkel's government in Berlin, the European Central Bank in Frankfurt, and the European Commission in Brussels, have transformed the financial crisis, which affected the whole Western world, into a much deeper economic and political crisis, which is causing huge unnecessary suffering and ultimately threatens to destroy the European Union. Because let's face it, no advanced economies in living memory have been as badly mismanaged as the eurozone has been in recent years. While most Western economies are struggling to recover from the financial crisis and the ensuing balance sheet recession, the eurozone is doing exceptionally badly. Whereas the US economy is nearly 10% bigger than in early 2008, the UK economy is more than 5% bigger, the eurozone is still 1% smaller. In fact, Europe is actually doing worse, the eurozone is actually doing worse than Europe did in the 1930s. Back then, the sterling bloc, the countries that quit the gold standard in 1931, recovered relatively quickly. The gold bloc, the countries that remained on the gold standard until 1936, stagnated. Well now, 8 years into the crisis, the eurozone as a whole is actually doing worse than the gold bloc was doing at this stage of the Great Depression. Now, huge attention has focused on Greece, where the situation is truly catastrophic. The government is insolvent, the economy has shrunk by more than a quarter, basically all sorts of social indicators are off the scale terrible, and the country is basically being run as a quasi-colony by Berlin and Brussels. But many other countries are in a deep hole too, including in Northern Europe. So you might not know, for example, that Finland has shrunk by more, by 7.3%, than Portugal has done since the beginning of the crisis, or indeed that the Netherlands in Northern Europe is doing worse than France. And while Germany's perspective may look relatively good within the eurozone, Germany is actually done worse since the crisis began than Britain, and much worse than Sweden, Switzerland, and the United States. At this point, someone will say, but hang on a minute, we have a recovery. The eurozone economy is growing again. And yes, that's true. At the moment, the eurozone is benefiting from some powerful tailwinds. Consumers and companies are benefiting from a near halving of oil prices over the past year. We have a much weaker euro, which benefits exporters. The trade-weighted exchange rate is down by about 10% over the past 18 months. Governments are no longer tightening their belts. Austerity, at least in terms of current fiscal tightening, is over. We now have broadly neutral fiscal policy across the eurozone. And last but not least, the ECB has finally embarked on quantitative easing, QE, i.e. central bank purchases of government bonds. And you've seen that long-term interest rates have fallen sharply since at the beginning of 2014, and that bank lending to businesses is finally starting to edge up after more than 3 years of decline. But even with all those positive factors, the eurozone is still barely growing. It grew by just 1.5% in the year into the second quarter, and already it's starting to slow again. Inflation has barely picked up, and the ECB has just revised down its growth and inflation forecasts. And if you have economies struggling with huge debts, the fact that nominal GDP growth is exceptionally weak makes it very hard to cope. And yes, unemployment is falling, but it remains incredibly high. 1 in 9 people across the eurozone, and much more than that in southern Europe, and much more even than that among young people. 1 in 2, more than 1 in 2 young Spaniards and young Greeks unemployed, a lost generation in the making. And then, if you think about it, if the eurozone can scarcely lift off with all the positive tailwinds that I mentioned, how on earth is it going to cope with the Chinese slowdown that we're beginning to see, or the rise in US interest rates, which is expected eventually, or the emerging markets crisis, or a flare-up of the crisis in Ukraine and Greece, or indeed the Volkswagen crisis, whose ultimate repercussions are potentially huge, or indeed some other event that we haven't thought of. And the problem isn't just that the eurozone economy remains weak, it's that basically European integration is falling apart. You've seen that the crisis in the eurozone has fragmented financial flows. So you see that banks, markets and regulators are limiting cross-border capital flows. And you've seen that explicit capital controls have been imposed first in Cyprus and then in Greece. The crisis has caused economies to diverge. So you see that poorer countries like Greece and Portugal are falling further behind richer ones. And even the ECB has recently recognized that the euro is failing in its promise to deliver convergence within the eurozone. And of course also the crisis has shredded support for the European Union. Back in the day, the European Union was associated with peace, prosperity, democracy and freedom. Now it's associated with austerity, recession, German domination, with undemocratic constraints on what people can do, instead of how we can all achieve more together. And crucially, the crisis has set Europeans against each other. So you see understandable anger at the injustice of bailouts for rich bankers and budget cuts for poor school children, overlapping with a despicable scapegoating of outsiders, notably immigrants. You have old stereotypes revived and new grievances created. So Northerners now openly slander Southern Europeans as being lazy good-for-nothings. In fact, Southerners work longer hours than Northerners do. Germans actually work among the lowest hours in the European Union. And then you hear equally outrageously Greeks labelling Germans Nazis. You see nasty nationalism, which the EU was meant to cure, on the march again. And you see many Europeans who are understandably angry and resentful at incompetent and sometimes corrupt establishment politicians and EU technocrats who basically seem incapable of solving the crisis, who bailed out the banks while imposing misery on ordinary voters, but not, of course, on themselves. And then you see that across Europe, voters increasingly turning to anti-establishment parties. Far left ones, which want a radically different and fairer Europe, and far right ones, which want to quit the euro and do many other nasty things, as well as more positively independence here in Ireland. In France, for example, Marine Le Pen's Front National is ahead in the polls. In Italy, while the Prime Minister Matteo Renzi remains popular, all 3 main opposition parties are now anti-euro. And of course, resentment of the bailouts in Southern Europe are also boosting anti-euro movements in Northern Europe. So basically, politics may yet achieve what pacified markets are failing to do. With luck, force desirable policy change, but potentially break up the euro. So that's the big picture about where we are now. So let me basically briefly explain what's wrong with the eurozone, how we got into this mess, and how to put it right. Now, the economic weakness in the eurozone is partly due to long-standing supply-side problems. A lack of innovation and enterprise, cartelized product markets, ossified labour markets, rigged and subsidised land markets, and in some countries a bloated and inefficient public sector. And you can see that in the decade before the crisis, and indeed since then, that productivity growth has been exceptionally low across the eurozone, not in Ireland, but yes, certainly in Germany too. And I think this lack of dynamism is in part due to cultural factors. It's about a suspicion of change, an aversion to taking risks, and a pessimism about the future. But I think mostly what it's about is crony capitalism, the capture of governments by vested interests that stifle opportunity and seize the value created by others. And obviously the most egregious example of that is the financial sector, but it's true in many other sectors too. To make matters worse, you have demographic decline setting in. The working age population of the eurozone has been falling since 2011. And if you combine poor productivity and demographic decline, one could imagine that the long-term rate of growth of the eurozone could be as low as 1% a year. So yes, supply-side issues matter. But if the long-term rate of growth is only 1% a year, the eurozone should still have grown by 7% over the past 7 years, which tells you that actually most of the current problem is due to deficient demand. Now, if you look what's happening now at the eurozone, growth is no longer being driven by net exports. It's no longer being depressed by austerity. It's largely driven by consumption. But here's the problem, is that debtors can't spend much and creditors won't spend much. And that's true both within countries, people who are asset rich in Ireland versus people who have big debts. And it's true across countries where you see Germany, which has the potential to spend much more, is actually a huge net saver. It has this massive and growing current account surplus. You see that investment, which is the bridge between today's depressed demand and tomorrow's expanded supply, is weak across the eurozone. It's 15% below pre-crisis levels. Both business and government investment are at record lows as a share of GDP. And I think business investment is weak because demand is weak. It's weak because many companies have big debts. And it's weak because those companies that do want to borrow often are denied credit by banks. And the thing is, there is no end to this misery in sight. Because if you accept my analysis that basically this is a balance sheet recession, a recession caused by a collective effort to reduce debts, we are 7 or 8 years into a deleveraging crisis, and the thing is there's been scarcely any reduction in debt at all. And the longer term danger is that you combine the poor productivity growth, the dismal demography, the inadequate investment, the crushing debts, the impaired banks, that basically the eurozone gets trapped in permanent or semi-permanent near stagnation. And then that threatens the sustainability of public debt, and of course it threatens the viability and the survival of the euro itself. So how did the eurozone get into this mess? Now, if you listen to the official narrative, which is put out by the German government or indeed EU institutions, the crisis is entirely due to others. It's due to profligate, in particular to profligate and reckless Southern Europeans. And for the purposes of this, so I'd have to keep on saying and Irish, Ireland is becoming Southern European for the purpose of this lecture. This narrative argues that since others, not least Germany, are not responsible for the crisis, they don't have to pay the price for it, others should. Germany doesn't need to change, others do. As well as paying back their debts in full, they must emulate what Germany did a decade ago, consolidate its public finances, and bear down on wages to restore competitiveness. And that way, so the official story goes, they can all be as successful as Germany supposedly is. Now that's the official narrative. There's just one problem with it. It's entirely false. Now the true story is as follows. As everyone in this room knows, because Ireland was at the centre of it, In the years up to 2007, there was a huge credit boom across the Western financial system, from the United States to Iceland. And it involved a massive expansion of cross-border lending by dangerously undercapitalized and dysfunctional banks. And they were abetted by the complacency and sometimes the complicity of central bankers, regulators, supervisors, and politicians. And Eurozone banks were right at the heart of it. As well as gambling on American subprime mortgages, German and French banks lent too much badly to Spanish property developers, as well as Irish ones, to Portuguese consumers, to the Greek government, both directly but also primarily by lending to local banks. The bubbles burst, banks fail, governments decide to bail them out, thus in effect saving their creditors. Now, those initial losses that banks suffered in 2007-8 were primarily due to losses on American subprime mortgages, over which European governments had no control. But in 2010, when it became clear that Greece could not pay its debts, Chancellor Merkel, together with a French trio of Jean-Claude Trichet at the ECB, Dominique Strauss-Kahn at the IMF, and President Sarkozy, decided to take a different approach. To avoid losses for those French and German banks, they decided to pretend that Greece wasn't insolvent. Actually, it was just going through temporary funding difficulties. And then, under the pretense that the financial stability of the Eurozone as a whole was at risk, they decided to breach the legal basis on which the Eurozone was formed, the no bailout rule, and to lend to the Greek government, so that it could repay those foreign banks and investors. Further loans from EU governments followed to Ireland, to Portugal, and to Spain, primarily to bail out local banks that otherwise would have defaulted on their borrowing from French and German banks and other financial investors. Now, here's the thing. As a result of those bailouts, the bad lending of private banks became obligations between governments. So a crisis that could have united Europe in a collective effort to curb the banks that got us into this mess has instead divided it, pitting creditor countries, primarily Germany, against debtor ones, with EU institutions becoming instruments for creditors to impose their will on debtors. In effect, the Eurozone has become a glorified debtor's prison. And along the way, Eurozone policymakers have behaved outrageously. They forced out the elected prime ministers of Italy and Greece and replaced them with unelected technocrats who would do their bidding. The unaccountable troika abused crisis-hit countries' need for liquidity to impose inappropriate policies on them. And policymakers illegally threatened to deprive Greeks, Irish people, and by extension anyone else, of the right to use their own currency, the euro, unless their government accepted punitive conditions. So you can see that, like Weimar Germany, Greece has been forced to accept brutal austerity measures in order to continue servicing an unbearable debt burden. Or here in Ireland, taxpayers have been lumbered with a 64 billion euro bill, 14,000 euros per person, for banks' bad debt. Now, if you think about it, taking advantage of Europeans' desperate desire to be part of Europe and their fear of being forced out of the euro to impose these iniquitous conditions on them is the very opposite of the solidarity on which the European project is meant to be based. Now, it's tragic, but hardly surprising that as a result, Germany and EU institutions are now resented as much in debtor countries. And it's also understandable that Northern European taxpayers are angry and resentful that their money has been lent to Southern Europe. But they shouldn't resent Southern Europeans and Irish people for that. They should direct their anger at the banks that their loans in effect bailed out, and at the policymakers who made it happen. And the tragedy of all this, and we've just seen it played out over the past 6 months, is that European taxpayers now have an incentive to resist the debt relief that Greece needs to recover. They would lose out if the €64 billion bank debt imposed on Irish taxpayers was written down. So by putting the narrow interests of the banks ahead of those of ordinary citizens, Eurozone policymakers have set Europeans against each other. And that is causing the political unravelling of the European project. So we've seen that governments bailed out the banks, first directly and explicitly, and then indirectly and covertly through the EU loans to crisis-hit governments. But they didn't force the banks, by and large, to clean up their balance sheets. So as a result, the Eurozone now has state-sponsored zombie banks that use the cheap liquidity, the cheap cash provided by the ECB, to roll over their bad loans to zombie borrowers while denying new borrowers fresh credit. And the flip side of failing to force banks to clean up their balance sheet is that many households and companies are still lumbered with huge debts. Basically, they can carry on servicing them at low interest rates, but they cannot hope to pay them back. Now, until 2010, governments were at least supporting the private sector's desire to save more by borrowing more themselves. But after Greece's public debt problems came to a head in 2010, policymakers wrongly decided that the Eurozone as a whole faced a generalised fiscal crisis and embarked on premature, excessive, collective austerity. But the fact is, Greece was the exception, not the rule. Higher government borrowing was not the cause of the Eurozone's problems, but rather a consequence of the collapse of private spending when the bubbles burst, banks went bust, and private debts suddenly loomed larger. And since households and companies didn't want to spend, banks didn't want to lend, and foreign demand wasn't big enough to fill the gap, austerity caused such deep recessions that perversely public debt soared much higher than it otherwise would have been. Worse than that, policymakers' successive mistakes sparked panic, to which they responded by demanding ever greater austerity, until finally, in the summer of 2012, after long insisting that it was legally unable to act, the ECB finally stepped in to quell the panic. Since then, the panic abates, economies stabilise, but they're still in a mess because the underlying causes of the problems still haven't been tackled: the broken banks, the private sector debts, the shortfall of demand. So I think it's clear what's happening now in the Eurozone is nothing like Germany went through a decade ago. Back then, Germany wasn't suffering a banking crisis. It didn't have huge private debts that households and companies were trying to reduce. And it was surrounded by booming economies to which it could easily export more. So when Chancellor Merkel repeats like a mantra that Germany's earlier experience shows that fiscal consolidation can be compatible with growth, she is comparing apples and oranges. Unfortunately, though, at Germany's behest, the Eurozone is now locked into a stifling and undemocratic fiscal straitjacket. Both the much more restrictive Stability and Growth Pact rules and, of course, the Fiscal Compact. Now, these are unnecessary because the original fiscal rules didn't fail, except in failing to spot the Greek government's lying. The crisis was caused by failures in the Eurozone's financial governance, not fiscal governance. But because Merkel made that mistake of breaching the no bailout rule, German taxpayers suddenly felt that they were liable potentially for everyone else's debts. So she demanded much greater control over other countries' budgets, and the European Commission was only too happy to grab new powers. Now, if you think about it, that's economically dangerous because economies that share a currency need greater fiscal flexibility, not less. And it's politically poisonous because when voters in a country throw out their government, as they have done at almost every election since the crisis, the first thing that happens is that EU officials pop up on television and say, you must stick to exactly the same policies of the government you have just rejected. Now think about it, that remote, unaccountable, unelected officials in Brussels should deny voters legitimate democratic choices about tax and spending decisions, alienates people from the EU. And if voting for mainstream politicians doesn't lead to change, it's hardly surprising that people are turning to the extremes. That's one way in which Germany has perverted the institutions of the Eurozone. The other way is to try and impose its mercantilist economic model on the Eurozone. Basically, it's a myth that the German economy is a success. What it's basically done over the past decade is that it's suppressed wages in order to subsidize exports. And basically what that does is that beggars Germans and it beggars its neighbors too. First, the facts. Since the launch of the euro, Germany ranks 15th out of 19 countries in terms of GDP growth. Back then it was called the sick man of Europe, and it didn't respond to that by becoming more dynamic, it just responded by cutting costs. It's now had more than a decade of underinvestment, and its arthritic economy has worse productivity growth even than Portugal. And who suffered from this? German workers. German workers earn no more than 1992 in real terms. Now, if you speak to Wolfgang Schäuble, he'll say, well, holding down wages is a good thing because it makes us more competitive. But the fact is, countries are not companies. If you are an individual company owner, it might make sense to try and keep wage costs to a minimum. But as a country as a whole, wages are not a cost to be minimized, they are a benefit to be maximized, provided they are justified by productivity. And because compressing wages suppresses domestic demand, Germany can only grow by exporting. But now that the Chinese economy is slowing and that the rest of the Eurozone is doing poorly, Germany is doing poorly too. So when German policymakers say, isn't it amazing, we've got a huge current account surplus, it shows how successful and competitive we are. Well, hang on a minute. If Germany is so successful, why don't companies want to invest there? Actually, those surpluses are symptomatic of a sick economy, and that harms the rest of the Eurozone too. Why? Because during the bubble years, those huge surplus savings created in Germany from suppressing wages were badly invested by German banks, which helped create the crisis. And now, those savings are being lent outside the Eurozone, and as a result, it's draining demand and causing deflation in the rest of the Eurozone. Now, on top of that, Germany is trying to impose the same economic model on the whole of the Eurozone. What does that do? Well, first of all, if you hold down wages, you slash incomes, that depresses domestic consumption, and it makes those huge debts harder to bear. And if you're a struggling southern European economy, like Italy or Spain, whose traditional exports have been undercut by Chinese competition, the solution is not to try to produce the same old products at ever lower wages. It's to invest in moving up the value chain to produce new and better products for higher wages. And then, of course, you have the fact that with the eurozone, the second largest economy in the world, and global demand so weak, it is impossible for the eurozone as a whole to grow strongly by relying solely on exports. So the eurozone urgently needs to change course. The problem is that the mistakes that policymakers have made have created new obstacles to resolving the crisis. I've seen how northern taxpayers now have an incentive to resist the debt relief that Southern Europe needs to recover. You have the debt overhang, which is leading to massive deflationary pressures, whose tackling requires policies that offend German monetary taboos. You have the fiscal straitjacket, which prevents governments from stimulating demand. You have the antagonism between North and South, the broader resentment of a quasi-hegemonic Germany, the corrosion of support for EU institutions, and all of that precludes further integration. And crucially, because today's chronic misery seems less pressing than the acute panic which is over for now, and to put it bluntly, because Germany isn't suffering enough, there is a dangerous complacency among policymakers who are often detached from those who suffer the consequences of their bad decisions and unaccountable to them. So you see, the debate in Brussels is basically stuck in a rut. Germany has been saying the same thing for 5 years. We need fiscal consolidation and structural reforms, i.e. wage cuts. You see France and Italy saying, well, we'd like to borrow a bit more if we do a bit more reform. You see the European Commission announcing a 315 billion euro investment programme which involves no new public money. You see the ECB continuing to pump liquidity into eurozone banks when the real problem is not that they lack cash, but the bad dents on their balance sheets. And now you have markets pinning their hope on ever greater QE, which has eased the pain a little, but isn't a cure. So to finally solve the crisis decisively and fairly, this is what you need to do. First, the eurozone needs to tackle balance sheet problems much more vigorously. It means that Greece needs debt relief. It means that the eurozone as a whole needs to finally clean up its banks, encourage the restructuring of corporate and mortgage debt, including here in Ireland, and to facilitate corporate insolvency and personal bankruptcy where necessary. By bringing debts down, households will be able to spend more and businesses to invest more. Second, Germany and other creditor countries need to play their part in the adjustment by boosting demand. In recent years, we created a mechanism in the eurozone for tackling dangerously excessive imbalances, the biggest of which is Germany's current account surplus. The European Commission needs to enforce the rules. Thirdly, both creditor and debtor countries need to do more to boost investment. It's absolutely absurd that the EU fiscal rules make no distinction between borrowing to boost bureaucrats' pay and borrowing to invest in projects that create future growth and future tax revenues. No business would fail to look at the asset side of the balance sheet as well as the liability side. And one spur to private investment in many countries would make it easier to start and grow a business. More broadly, all governments need to reform more, but those reforms should be focused on boosting productivity so that those productivity gains can pay for higher wages and increased consumption. The idea that we should neglect productivity growth, which is basically what's happened, while bearing down on wages in a mercantilist pursuit of competitiveness is a dead end. And looking to the future, a greying eurozone needs more young workers, which is why in many countries you need to open up the labour market to young people, and which is why the refugees who are arriving in Europe should be welcomed. They are an economic opportunity for the future. Let me conclude with a few suggestions about how to improve the how the eurozone institutions work in future. They're not essential for solving the crisis, but they're essential for making the eurozone work better in future. You need a genuine, comprehensive and robustly independent banking union with a workable mechanism for bailing in the creditors of failed banks. We still don't have that. You need to enshrine the ECB's role as a lender of last resort to solvent governments so that we avoid the panic that we saw in 2010 to 2012. We need to restore the no bailout rule, and with it much greater fiscal flexibility for democratically elected governments to borrow and spend as voters please, constrained of course by markets' willingness to lend and ultimately by the threat of default. And ultimately, the freer, fairer and richer eurozone that would result would be in everyone's interests, including Germany's. Now, in a normal democracy, 8 years of economic failure would have forced a change of course by now. But eurozone governments are bound together by lopsided rules and dysfunctional institutions, and bullied into submission by Berlin. So the barriers to change are huge. We need a European spring of economic and political renewal to change things. Thank you.